You know what nobody's talking about? While everyone was glued to their screens watching the S&P 500 hit new highs, there's a quiet group of investors who've been consistently outperforming the market, and they're not using some complicated trading algorithm or chasing the latest tech stock. They're doing something that Wall Street has been telling you is outdated for decades. They're holding gold. And here's the thing that's going to blow your mind. From 2000 through 2024, gold hasn't just kept pace with the stock market, it's actually outpaced the total returns of both the S&P 500 and the NASDAQ 100. Let that sink in for a second. All those financial advisors telling you to put everything in index funds? They left out a pretty important detail. But this isn't just about past performance. What's happening right now is something I haven't seen in my entire career analyzing precious metals markets. And I need to show you exactly what's unfolding, because the implications for your retirement are massive. Let me take you back to a conversation I had 3 weeks ago with a 68-year-old retiree named Robert. He called me after watching his neighbor lose 40% of his portfolio in 2022. Robert had done something different. Back in 2020, he moved 30% of his IRA into physical gold. Not gold stocks, not gold ETFs, physical gold held in a qualified custodian. And while his neighbor was panicking, watching his retirement dreams evaporate, Robert's portfolio barely moved. In fact, by the end of 2024, he was up significantly. Now, Robert isn't some financial genius. He's a retired electrician from Ohio. But he understood something that most people miss. He understood that gold isn't just an investment, it's insurance. And right now, that insurance policy is paying out in ways that are shocking even the most seasoned market analysts. Let's talk about what just happened in 2024. Gold hit record highs, breaking through $2,700 an ounce. But here's what's fascinating. It didn't do it because of inflation fears or economic collapse. It did it while the stock market was also hitting record highs. That's not supposed to happen according to traditional market theory. Gold is supposed to move inverse to stocks. But something fundamental has changed in the global financial system, and if you don't understand what's driving this, you're going to miss the biggest wealth transfer of our generation. Central banks are buying gold at a pace we haven't seen since 1967. Think about that date for a second. 1967 was right before Nixon closed the gold window in 1971 and ended the Bretton Woods system. Central banks knew something was coming. They were preparing. And they're doing the exact same thing right now. The People's Bank of China has been adding to its gold reserves for 18 consecutive months. That's not a coincidence. That's a strategy. Poland just announced they're increasing their gold reserves to 20% of total reserves. Turkey, India, Singapore, they're all accumulating. And these aren't small purchases. We're talking about hundreds of tons of physical gold being pulled out of the market every single quarter. But here's where it gets really interesting. While central banks are buying, Western investors have been selling. Gold ETFs saw massive outflows in 2023 and early 2024. Retail investors were dumping gold to chase AI stocks and crypto. And you know what happened? The price went up anyway. That tells you something profound about the supply and demand dynamics at play here. See, there's a difference between paper gold and physical gold. When you buy shares of GLD or any gold ETF, you're buying a claim on gold. You don't own the actual metal. You own a piece of paper that says you're entitled to a certain amount of gold. But when central banks buy gold, they're taking physical delivery. They're removing actual bars from the market, and there's only so much physical gold available. The London Bullion Market Association, which is basically the central hub for global gold trading, has been showing some really interesting stress signals. The spread between paper gold prices and physical gold prices has been widening. That means it's getting harder and harder to actually get your hands on physical metal, even though the paper price suggests there's plenty available. This is exactly what happened in the 1970s. From 1971 to 1980, gold went from $35 an ounce to $850 an ounce. That's a 2,300% increase. But it didn't happen overnight. It happened in waves. There would be a surge, then a pullback, then another surge. And each time the skeptics would say, "That's it. Gold's done." And each time, they were wrong. We're seeing the same pattern now. Gold hit $2,700, pulled back to $2,600, and now it's consolidating. The mainstream media is already writing articles about how the gold rally is over, but they're missing what's happening beneath the surface. Let me show you something that's not getting enough attention. The cost of mining gold has skyrocketed. The average all-in sustaining cost for gold miners is now around $1,400 an ounce. That means miners need gold to stay above $1,400 just to break even. But here's the kicker. The easy gold has already been mined. Every new ounce that comes out of the ground is more expensive than the last. We're not finding new major gold deposits. The last major gold discovery was in the 1990s. So you've got declining supply, increasing production costs, and surging demand from central banks. That's a recipe for much higher prices. But there's another factor that nobody's talking about. The dollar's reserve currency status is being challenged in real time. The BRICS nations, Brazil, Russia, India, China, and South Africa, just expanded to include Saudi Arabia, UAE, Egypt, Ethiopia, and Iran. That's not just a political alliance. That's a direct challenge to dollar dominance. And these countries are settling trade in their own currencies, bypassing the dollar entirely. When you bypass the dollar, you need something else to settle international trade. And historically, that something else has always been gold. Saudi Arabia just let their 50-year petrodollar agreement with the United States expire. Think about the implications of that. For 5 decades, oil could only be purchased in dollars. That created automatic demand for dollars worldwide. That agreement is now gone. And what's Saudi Arabia doing? They're buying gold. They're diversifying away from dollar-denominated assets. This is the kind of structural shift that happens once in a generation, and most people won't realize what happened until it's already over. They'll wake up one day and wonder why gold is at $5,000 an ounce, and their dollar-denominated savings have lost half their purchasing power. Now, I know what some of you are thinking, but gold doesn't pay dividends. It doesn't generate cash flow. It just sits there. And you're right. Gold doesn't pay dividends. But you know what else doesn't pay dividends? The cash sitting in your savings account. And that cash is losing 3 to 4% of its purchasing power every single year to inflation. At least gold maintains its purchasing power over time. Let me give you a concrete example. In 1971, the average house in America cost $25,000. An ounce of gold cost $35. That means you needed about 714 ounces of gold to buy a house. Today, the average house costs $420,000. Gold is at $2,650 an ounce. You need about 158 ounces of gold to buy that same house. Gold has not only kept pace with housing prices, it's actually outperformed them when you factor in the total cost of ownership. The same is true for cars, education, healthcare, basically every major expense. Gold has maintained its purchasing power, while the dollar has lost over 98% of its value since 1971. That's not a theory. That's mathematical fact. But here's where this gets personal for retirees. If you're 60 or older, you don't have time to recover from a major market crash. If the stock market drops 40% like it did in 2008, and you're pulling money out for living expenses, you're selling at the bottom. You're locking in those losses, and you may never recover. Gold provides a buffer. It's not about getting rich quick. It's about preserving what you've already built. It's about making sure that the money you've saved over 40 years of working doesn't evaporate in a market crash or get inflated away by reckless monetary policy. And speaking of retirement accounts, here's something most people don't know. You can actually hold physical gold inside an IRA. It's called a gold IRA, and it's been around for decades. The IRS allows you to hold certain types of gold, silver, platinum, and palladium coins and bars in a self-directed IRA. You get the same tax advantages as a traditional IRA, but instead of holding stocks and bonds, you're holding physical precious metals. Now, if you're sitting on $100,000 or more in retirement accounts, this might be worth looking into. I actually put together a free guide that explains exactly how gold IRAs work, how to set one up, what the costs are, and how to avoid the common mistakes people make. It's in the description below. No obligation, just information. Because I think it's important that people understand all their options when it comes to protecting their retirement. All right, back to what's happening in the market right now. Because there's another piece of this puzzle that's absolutely critical to understand. The commercial banks are massively short gold on the COMEX Futures Exchange. These are the big players, JP Morgan, HSBC, Goldman Sachs. They've been shorting gold for years, essentially betting that the price will go down. But here's the problem. They're not just speculating. They're providing liquidity to the market. When someone wants to buy gold futures, these banks sell them those contracts. And they've sold a lot of contracts. More contracts than there is physical gold available to deliver. It's called fractional reserve gold trading, and it's the same concept as fractional reserve banking. As long as everyone doesn't ask for delivery at the same time, the system works. But what happens when central banks start demanding physical delivery? What happens when investors lose faith in paper gold and want the real thing? You get a squeeze. And we're starting to see the early signs of that squeeze right now. The COMEX gold inventories have been declining. Registered gold, which is gold available for delivery, is at multi-year lows. Meanwhile, open interest, which represents the number of outstanding contracts, remains elevated. That's a dangerous combination. It means there are more claims on gold than there is gold available to satisfy those claims. If this continues, we could see a situation where the paper price and the physical price completely disconnect. You might see gold trading at $3,000 on the COMEX, but if you want to actually buy a physical bar, you're paying $3,500 or $4,000. That's not speculation. That's exactly what happened with silver in 2020 during the Reddit squeeze. The paper price was $25, but try finding physical silver for less than $35. And here's why this matters for you. If you own gold ETFs, you own paper gold. You're exposed to that disconnect. But if you own physical gold, or if you own gold in a qualified IRA custodian that holds physical metal, you're protected. You actually own the asset, not just a claim on the asset. This is the kind of detail that financial advisors don't tell you, because most of them don't understand the mechanics of the gold market. They just know that their firm makes more money when you buy stocks and bonds, so that's what they recommend. Let me tell you about another retiree I spoke with. Her name is Margaret. She's 72, and she had her entire retirement in a traditional 60-40 portfolio. 60% stocks, 40% bonds. That's what her advisor recommended. In 2022, she lost 18% of her portfolio value. Both stocks and bonds got hammered at the same time. She was devastated. She thought she was being conservative by holding bonds, but bonds had their worst year in decades. Margaret called me in early 2023, and we talked about diversification, real diversification, not just owning different stocks. She moved 25% of her portfolio into physical gold and silver. And you know what happened? In 2024, while the stock market was volatile and bonds were still struggling, her precious metals position was up over 30%. That 25% allocation saved her retirement. Now, I'm not saying everyone should put 25% in gold. Your situation is different. But I am saying that having zero exposure to physical precious metals in this environment is a massive risk, because everything else in your portfolio is denominated in dollars. Your stocks, your bonds, your cash, your real estate, it's all priced in dollars. And if the dollar loses value, everything loses value simultaneously. Gold is the only asset that's not someone else's liability. When you own a stock, you're relying on that company to perform. When you own a bond, you're relying on that government or corporation to pay you back. When you own dollars, you're relying on the Federal Reserve to maintain the currency's value. But when you own gold, you're not relying on anyone. It's just an asset. It has value because it's scarce, durable, and has been recognized as money for 5,000 years. And that brings me to what I think is going to happen next. We're entering a period of monetary instability, unlike anything we've seen since the 1970s. The Federal Reserve has printed more money in the last 4 years than in the previous 100 years combined. The national debt is $36 trillion and growing by $1 trillion every 100 days. That's not sustainable. Something has to give. When it does, gold is going to reprice dramatically higher. Not because gold is becoming more valuable, but because the dollar is becoming less valuable. And the retirees who understand this, who have positioned themselves accordingly, they're going to be fine. They're going to maintain their purchasing power. They're going to be able to afford groceries and healthcare and all the things they need in retirement. But the retirees who ignored this, who kept 100% of their wealth in dollar-denominated assets, they're going to struggle. They're going to watch their savings evaporate in real terms, even if the nominal value stays the same. Here's a historical parallel that should terrify you. In 1980, gold peaked at $850 an ounce. Adjusted for inflation, that's about $3,200 in today's dollars. We're at $2,750 right now. That means gold hasn't even reached its inflation-adjusted all-time high yet. And the monetary situation today is far worse than it was in 1980. The debt is higher, the money printing is more extreme, and the geopolitical tensions are more severe. If gold simply matches its inflation-adjusted 1980 peak, we're looking at $3,200. But if it overshoots, like it did in 1980, when it went parabolic in the final months, we could easily see $4,000 or $5,000. And that's not some wild prediction. That's just gold doing what it's always done during periods of monetary chaos. The smart money knows this. That's why Ray Dalio has been recommending gold. That's why Stanley Druckenmiller increased his gold position. That's why Paul Tudor Jones said he's long gold. These are some of the most successful investors in history, and they're all saying the same thing. Gold is undervalued relative to the risks in the system. But here's what's different about this cycle. In previous gold bull markets, it was mostly Western investors driving the price. Americans, Europeans, buying gold as a hedge against their own government's policies. This time, it's central banks. It's Eastern nations. It's a fundamental restructuring of the global monetary system. And that makes this move much more powerful and much more sustainable. China isn't buying gold because they think it's going to go up 20% next year. They're buying gold because they're preparing for a world where the dollar is no longer the dominant reserve currency. Russia isn't buying gold for short-term gains. They're buying it because they've been cut off from the Western financial system and need an alternative way to settle international trade. These are strategic moves by nation-states, not tactical trades by hedge funds. And when nation-states move, they move size. They move hundreds of billions of dollars. That creates a floor under the gold price that didn't exist in previous cycles. So, where does this leave you? If you're a retiree or approaching retirement, you need to seriously consider your exposure to monetary risk. Not market risk, monetary risk. The risk that the currency your wealth is denominated in loses purchasing power, because that's the risk that's not being priced into traditional portfolios. A 5% allocation to gold is better than nothing, but it's probably not enough given what's coming. 10–15% is more reasonable. 20–25% if you're particularly concerned about dollar devaluation, and it needs to be physical gold or gold held in a qualified custodian, not paper gold that can be printed infinitely. The retirees who are beating the market right now, they figured this out years ago. They didn't wait for CNBC to tell them it was okay to own gold. They didn't wait for their financial advisor to recommend it. They looked at the fundamentals, they looked at history, and they made a decision to protect their wealth. And here's the beautiful thing about gold. You don't need to time it perfectly. You're not trying to buy at the absolute bottom and sell at the absolute top. You're building a position over time. You're dollar cost averaging into an asset that has maintained its value for thousands of years. Some months you'll buy higher, some months you'll buy lower, but over time, you're protecting your purchasing power. I've seen this play out over and over again. The people who wait for the perfect entry point never buy. They watch gold go from $1,800 to $2,000 and think, I'll wait for a pullback. Then it goes to $2,200 and they think, it's too high now. Then it goes to $2,500 and they've missed the entire move. Meanwhile, the person who just started buying at $1,300 and kept buying every month is sitting on substantial gains. The time to buy insurance is before you need it. Once your house is on fire, it's too late to call the insurance company. And right now, there are a lot of fires starting in the global financial system. The commercial real estate market is imploding. Regional banks are failing. The bond market is showing stress. Geopolitical tensions are escalating. These are all warning signs that something bigger is coming. Gold is your insurance policy against all of it. It's not going to make you rich overnight, but it's going to preserve what you have. And for retirees, preservation is more important than growth. You've already done the hard work of accumulating wealth. Now you need to protect it. The retirees who are beating the market aren't doing anything complicated. They're not trading options or buying penny stocks. They're simply holding an asset that has proven itself over thousands of years. An asset that central banks are accumulating at record pace. An asset that's in limited supply and increasing demand. And they're sleeping well at night knowing that no matter what happens to the stock market, no matter what happens to the dollar, no matter what happens to the banking system, they have real wealth that can't be printed, can't be devalued, and can't be confiscated with the click of a mouse. That's the power of gold. That's why retirees with gold are beating the market again. And that's why you need to seriously consider whether your current portfolio is truly diversified or whether you're just holding different flavors of the same dollar-denominated risk. The choice is yours. But the window to act is closing. Because once everyone figures out what's happening, once the mainstream catches on to what central banks have been doing for the past 2 years, the price is going to gap higher, and you'll be buying at much higher levels than you could today. Don't be the person who looks back in 5 years and wishes they had acted. Be the person who took action, who protected their wealth, who understood that the rules of the game were changing and positioned themselves accordingly. That's what the retirees who are winning right now did. And that's what you can do too.